Now we got some earnings this afternoon. George Tsilis joining me to look at PVH, which has been one of the worst performing retailers in the market for some time, George. And the reasoning for that is waning popularity in generic kind of wholesale brands combined with the recognizable names, Hilfiger, Calvin Klein, a lot of stuff that's kind of fallen behind from the big box retail stores. But a little bit of a pop here in the aftermarket, GT. What do you see? Anything big?
Well, I don't see the EPS. If you can help me out there, OJ, but it looks like their fourth quarter revenue came in at $2.37 billion, if I'm not mistaken. So it looks like there was a slight beat versus the 2.34 estimate. Looks like the full year revenue decreased. Yeah. So this is I think the problem is if you look at the full year revenue too, it was down to $8.65 billion. Looking at the trailing 4 quarters prior to the quarter they just reported, it was around 8.7. So we're seeing a structural challenge from a decelerating revenue standpoint. I haven't seen the full EPS for the quarter just yet.
On the trailing was slightly ahead, 327 versus 321. Yeah. The outlook also was a nice beat. That's why we're rallying here in the aftermarket. Street was looking for 1158 for the fiscal year EPS, and they're saying they could go from 1240 to 1275. So that's a pretty good 10% beat there on their forward outlook for the bottom line. But it's not happening because revenues are going up, to your point.
Yeah, so actually that's quite meaningful because if the EPS, as you mentioned, estimates for the next fiscal 4 quarters is that high, I had about $11.78 at the midpoint. So that's quite meaningful. I think the composition of that is important. Now, just context here, these are some of the leading brands, Calvin Klein, Tommy Hilfiger, Izod, Van Heusen, and so forth. But the brands essentially have been sluggish for the trend standpoint. They're consolidating their brands. They're consolidating some of their brand positioning, but they're trying to remain relevant. If you look at the last year, growth has really stalled out. And in fact, prior to the revised guidance higher, the stall out was expected to continue because, again, prior to the announcement, they were only expecting $8.62 billion in sales and actually lower sales, $8.61 billion for 2026. So we're looking at a stock that's trading around 5 times this year's earnings. Now that's improving based on the $12 plus earnings guidance that the company provided. That's a significant improvement. But I think the composition of that earnings matters because one of the things I've noticed about their income statement is they've been buying back shares quite aggressively. In fact, since 2021, they've bought back close to 24% of the shares. Now, in the last year, the stock is still down, irrespective of the move in the after hours, about 53%, higher over the last 5 years by 72%. So I think there's a couple things going on. Sales have been weak. That might be part parcel of what's happening overseas, because if you look at the trend, it's been quite aggressive to the downside since early part of this year. Consumer discretionary stocks getting killed. The stock is not expected to grow very much in terms of earnings and sales, trading at a very low multiple, so it might be a bit of a value trap. But I think the share buybacks may be quite still compelling. I'm going to use that as the reason they're guiding quite a bit to the upside. I don't know that that's true just yet, but that's over $12 in EPS versus the $11.78. That's actually quite meaningful, so it may be based upon a share buyback.
Okay. That's a pretty good spot for them to be able to demonstrate, some financial stability right now, to go and buy back some shares in an otherwise challenging environment, and to wring out a little bit more on the bottom line, still contracting 5%, and out of style, I think, though. Appreciate it, GT. Thanks.